Hello friends, welcome to CEC Live Lectures. Dear friends, today in this session we are going to continue further in our series on financial accounting, and today we are going to discuss specifically on adjustment entries in final accounts. We would be talking in context to stock, outstanding expenses, prepaid income and expenses, as well as we are going to discuss on bad debts. And for the discussion on the topic, we have with us in our studios Dr. Amarjeet Kaur. Dr. Amarjeet Kaur is a professor of accounting, and she is teaching in one of the leading institutions of the country. We would like to quote that Dr. Amarjeet Kaur is a prolific professor. She is dynamic too, and she always believes in giving best to the students so that the student community is benefited as a whole. She is a certified management accountant from USA and an author of numerous books on accounting. So friends, let's take advantages from her experiences and let's try to understand today's topic in detail. Now, I would like to welcome our guest, Dr. Amarjeet Kaur, once again, and would request her to give us in-depth knowledge on today's topic. Hello ma'am, welcome to the
lecture. Hello Gitika, thank you very much. A very good morning to viewers and welcome on yet another session in accounting. So as Gitika introduced, we are going to talk about adjustment entries in final accounts, and agenda would be that we will be covering about 5 to 6 adjustment entries in the first half and the remaining 5 to 6 in the second half. So we'll begin with the basics. First thing, closing stock. Before talking about closing stock, let's understand what adjustment entries are and why there's a need to make any adjustments in final accounts. So as you know, we are in the process of preparation of final accounts. We have already started this topic way back to maybe 2 weeks back. So friends, in the final accounts, we intend to show a fair and true picture of financial position and operational result of a business. So operational results, as you know, we show in the statement of profit and loss account, and financial health, you know, we show in the balance sheet. Alright. So what happens, there's a particular day for every business which is decided in advance to close its books of accounts. So which we know as a year end. So for in India, for taxation purpose, the year is generally 1st April to 31st March. But doesn't mean that you cannot keep any other cycle for your keeping your books for your business. You can start from Vaisakhi day in India, you can start from a Diwali day, you can start from a Pongal day, you can start from any day to keep your books of accounts. But for the purpose of taxation, we need to close them on 31st March of every new year. So this is how a general understanding is. Now, when a business is supposed to close its books of account, let's say on 31st March, or in Western world it is 31st December. So either of the day, let's assume this as a for the sake of easiness. So what will happen? There could be many transactions which are in the process, which were there but have been ignored, which could not be completed, which could not be taken into account while preparing trial balance till the date of closing. So we have either ignored or we could not take into account couple of transactions. So what would be the impact if I am unable to record few transactions which actually belong to the current year in question? What would be the repercussion? I think you can think about it. The result would be our financial statements would not give a fair picture, a true picture, which is expected out of us. As an accountant, we are supposed to prepare our records in a way that we share a fair and true picture. So we will fail in our duty as an accountant if we do not take into account all those items which have not been able to have not been taken into account. So those items which are not part of the trial balance but still belong to the current year should be adjusted. So we need to make an adjusted trial balance and then prepare our balance sheet and profit and loss account. So these entries which are passed after preparing the first trial balance are known as adjustment entries. So to adjust items or variables of final accounts in a way so that we present a true and a fair picture of the financial results. That is the agenda. So I hope you understand what does adjustment entry stand for. Basically an entry to adjust so that we show correct value of revenue, correct value of expense, correct value of asset, liability or equity for that matter. And these are the 5 elements I have been emphasizing upon. Our final accounts, our financial statements is basically a combination of these 5 variables. So we have to ensure that we show correct value of all the 5 variables in question. So that's the background. Now let's begin with the first adjustment entry pertaining to closing stock. Now closing stock, as you know, is an inventory which is unconsumed. A business would be either into trading, buying and selling, or into manufacturing and then selling. So in both the conditions, there is a possibility that a business would have closing stock, that is stock unconsumed or unsold left with the business. So that stock, that inventory needed to be taken care when we are closing our books of accounts or preparing our final accounts. So what is the possibility? There are 2 different situations. One, that you have been given the closing stock within the trial balance. Another is that you have been given outside the trial balance. One important point to be remembered is this: any item which is given within the trial balance is going to be placed either in statement of profit and loss or in balance sheet. It's not going to go at 2 places. But if there is an item which is given outside the trial balance under additional information, that is going to be placed at 2 places at this point. It means that item has been completely ignored previously, has not been recorded at all, and it would go at 2 places by following the rule of double entry, by following the rule of equal debits and credit. So we have to keep this fact in mind. Now with this premise in mind, let's go further. So let's assume the closing stock is given inside the trial balance. Under that condition, what adjustment would you do, or how would you treat it? If it is given outside the trial balance, you simply take it as a stock, which is a current asset of course, and carry it or show it in the balance sheet. No adjustment entry is required, nothing is required. Adjustment entry is required for stock when the stock is given outside the trial balance, and stock, as we know, always have a normal balance as debit balance. I hope you remember the rule of normal balance from previous lectures. We begin with that and we have been quoting it, using it all through the lectures in this subject. So stock per se is a current asset and it should have a normal balance of debit, right? So if it has been ignored, it means you need to increase the debit value of the stock. So stock would be debited. So if I am putting the stock on the debit side, what would be there on the credit side? It would be trading account, or now if we are preparing combined trading and profit and loss account, then it would be statement of profit or loss as is required now. So stock would be debited and your trading account or statement of profit and loss account, as the conditions may be, would be credited. So we have to keep in mind the rule of debit and credit. That will make things very easy for you. You will won't find difficulty in dealing with the adjustment in case we are clear that what is the normal balance of the item given, of the variable given. Alright, so this is how we deal with the closing stock. You can have a look at those adjustment entries which we are going to discuss now. So after this closing stock, the next thing is we would now talk about the second item given here, that is outstanding or accrued expenses. So let's take this second item, outstanding or accrued expenses. So let's have a discussion first, and then we will take some example later on. So what are outstanding or accrued expenses? Accrued or outstanding expenses, when it comes to the accounting treatment, it is common, it is same for both. But there is one important difference to understand, and especially for those students who are into accounting must understand the difference between the two. So outstanding expenses means expenses which belong to the current year, expenses which have actually pertains to this financial year, and have against them we have received some benefit but we have not paid for them, right? So that is what outstanding expenses are. What are accrued expenses? Accrued expenses are, we have actually consumed the benefit but they have not become due to be paid in this current year. I hope you are able to understand the difference between the two. Under first condition, expenses belong to current year, we have received the benefit, but the point is the expenses have not become due. The due date is in the next year, it is not in this current financial year. So that is what is your accrued. In the outstanding, they belong to this year, the benefit or the service has been received, and they become due but they have not been paid. In both the condition, the point is we have not paid for the expenses for which we have received the benefit. But the difference between outstanding and expense and accrued is that outstanding they have become due, whereas accrued they have not become due in this financial year, they are going to get due in the next year. So hope you have gathered the difference between outstanding and accrued expenses. Now let's go further. What would happen if I do not adjust my books of accounts, right, for these accrued or outstanding expenses? Mind you, as I already mentioned, the accounting treatment and the effect on books of account is same under both the conditions. So what would happen if I do not consider them? Expenses are debit by nature, by normal account, and they are going to be subtracted from revenue of the current year to get profits or loss. So we know gross or net profit margins depending upon the nature of expense, either it will belong to trading account or it will belong to the profit and loss account. So expenses are supposed to be subtracted from your revenue and the remainder is your profit or loss. So if I do not consider expense which actually belong to this year, as per accounting concept, we follow accrual accounting. We do not follow cash accounting. So as per accrual accounting, doesn't matter I have paid for expenses or not. Important is they should belong to this year. And if I have received the benefit out of it already, it means that belongs to current year. So in that case, I am supposed to increase expenses in my books and pass a journal entry, right? So increase expenses means what and how to do it? First of all, let's be clear that expenses have normal debit balance. To increase the expenses, I should be debiting the respective expense account, right? If expense, say for example, if it is insurance expense which belong to this year but I have not paid yet, I shall be debiting the insurance. And what should be credited? Outstanding or accrued, based on whatever the situation may be. So this is how we do in journal. So let's have a look at the slide and let's take this small example to understand how do we actually pass a journal entry under outstanding and accrued expense situation. Let's have a look at the slide, please. The slide shows you extracts of trial balance, and this is for outstanding expenses. So particulars, so let be sure, be informed, this is not a complete trial balance. We have only extract, so part of the trial balance available to you. So salaries are given, expenses in the trial balance, and rent is also given in the trial balance. Respectively, amounts are 10,000 and 5,000, right? In the additional information, it says salaries for the month of December are 2,000 and they have not been paid yet. And the second information says rent amounting to 1,000 is still outstanding. So you are required to pass necessary adjustment entries and show how the above items will appear in the firm's final accounts. So we have to discuss two things, adjustment entries and how would we show them in the final accounts. So keep this data in mind, that salaries given are 10,000, rent which has already been recorded in the trial balance is 5,000, and unpaid amount is 2,000 for salaries and 1,000 for rent. With this information in hand, let's go and look at how would we pass adjustment entries. So we would be debiting salaries, because here the respective expense account is salaries. So we shall be debiting salaries by 2,000, right? And what would we be crediting? As I discussed, we would be crediting outstanding expense. We did not pay, right? So the respective expense account would have a prefix added to it. So we would say outstanding salaries account. Had it been insurance and which is outstanding, then it would be outstanding insurance. So the journal entry which would be passed is salaries debit. So salaries be having a normal balance of debit. So we shall be increasing the salaries account by 2,000. So instead of 10,000, my books should be recording 12,000 of expense for salaries. That's how it is. And then rent. Rent was again unpaid for 1,000. So rent is also an expense. We shall be debiting rent account and would be crediting outstanding rent expense account for 1,000 each side. Okay. So under both the condition, expenses have been increased because they belong to this year, and we have an onus as an accountant to show the fair and true picture. So that's why we debited salaries and rent both, and we have credited outstanding for salaries as well as expense. So this was pertaining to how to pass adjustment entry. Now the next question is that how to show them in the books of accounts, final accounts. Salaries of 2,000 and rent of 1,000 would be added in the statement of profit and loss account in the respective expense. So treatment is that we have to increase the respective expense account. Here salaries and rent. So 2,000 would be added to salaries in the profit and loss account. 1,000 would be added to rent in the profit and loss account, or you may say statement of profit and loss, right? Now in the balance sheet, as I said, anything given outside the trial balance would be shown at two places in the final account. So it means in profit and loss account as well as balance sheet. So in the profit and loss account, these values have gone on the debit side. In the balance sheet, it will go as liability, and especially current liability to be precise. So why current liabilities? Because we have already availed the benefit and we are supposed to pay it in very near future. So they would be shown as outstanding salaries and outstanding rent under the outstanding expense head in the liability side in balance sheet. So this goes to current liability section of the balance sheet. So we have shown at two places because we have not recorded them yet at all. Okay. So this was for outstanding expense. Now we will take up the second thing, which is prepaid expenses. What would happen, if we have paid something in advance? As the practice is in many places in businesses, employees may request you to pay them salaries in advance in case of there's a need. Especially in private organization, this happens. Advances can be given to employees in public places as well. So this could be one situation. You may pay advance insurance, you may pay rent in advance, you may pay any expense in advance as a business. So how this question is how to deal with such situation. So if we have not taken into account while preparing our trial balance anything paid in advance, so what should we be doing? So if you have paid in advance means that expense does not belong to this year. It means you have actually spent and shown more what you should have actually spent for the current year or should have accounted for. So it means some part of the expense which you have actually paid, the cash has gone, right? But belongs to next year. So we have an obligation to show fair value, true value of everything, either expense, revenue or asset or liability. So basically I have yet to avail the benefit for the expense which I have paid in advance, right? So that is my asset, something unconsumed, some expense which is unconsumed is basically a asset, is an asset, and something paid in advance should be reduced from the profit and loss account. Your expenses should be shown for the correct value, not for the value which doesn't belong to this year. So accordingly we should be reducing the respective expense account. Expenses have debit normal balance. To reduce it, what should we be doing? I hope you can make it out. We should be crediting it. Yeah, you are right. Because anything, whatever the balance it may have, a particular item may have, so depending upon what kind of adjustment we are supposed to do. Are we supposed to make a kind of upliftment or increase in the expense? So expenses have normal balance of debit. So if I have to increase it, simply debit it. If I have to reduce it, then simply credit it. So this is how it is, and so this rule is applicable all the time. So it's important to be very, very sure about normal balance. So when we say expenses have normal balance as debit and we are supposed to reduce the expense, it means I should be crediting it. Very simple. So if we know we have to credit the respective expense account, the next question is what is to be debited. We shall be creating a new account which is not there previously before this date when the adjustment is to be done, and that would be prepaid expense account. So to summarize that how to pass an adjustment entry, we shall be debiting prepaid expense account and shall be crediting respective expense account to record this overpayment of any expense in the books. So now with this discussion in mind and hand, let's take this further and take this example. Let's have a look at the slide which shows you extracts of trial balance for prepaid expense. So you have been given salaries, of 10,000 debit side of course, and rent 5,000. So this means this has already been recorded, and in the additional information it says salaries for the month of January 2000 has been paid in advance, alright, and rent amounting to rupees 1,000 is paid in advance. So I have purposefully taken the same data, only thing is that I have changed the situation. In the previous situation with the same data, the expenses were to be paid, they were outstanding, but here they have already been paid in advance, so they become as prepaid expenses. So we are supposed to make adjustment entries. So, as I said, as we discussed, we will create a new account. So, if you look at the slide, it shows you prepaid salaries account debit 2000 and salaries account credit 2000. So, now instead of debiting in the previous example, salaries were debited because we were supposed to increase it, and here we have actually credited it. So, prepaid salaries have been debited and salaries have been credited. Same way, prepaid rent has been debited and rent account has been credited. Alright, so hope you could understand that how the adjustment entries are passed. Now, the next thing is that what will happen to my final accounts. This was only the adjustment entries. So, how should I treat these items in my statement of profit and loss and my balance sheet? So, first of all, since I have paid in advance, I should be reducing this amount from my respective expense account in the profit and loss account. So, which means if my salaries were given X amount in the trial balance, which was 10,000, so now I shall be reducing this 2,000 from my salaries account. And if my rent was given 5,000 in the trial balance, I shall be reducing this 1,000 from my rent account. So, in the profit and loss account, what happens to balance sheet? In the balance sheet, we shall be having this prepaid expense as current asset. This is something which I have paid for, but I have yet to get the benefit for, right? So, I shall be showing it as a current asset in my books under the title prepaid expenses. Alright, so this is how it is going to be shown in the final accounts. So, these are about prepaid and outstanding expenses. Now, we shall be moving to the another point on revenue. So, the same way as the expenses are dealt it, we have to deal with the revenue. The revenue could be received in advance or could be actually accrued, outstanding, has not been received. You earned it and you yet have not received. So, we could have both the situations very much like expenses, but the only thing is revenue by nature have a different proposition. Revenue by nature they do not have debit balance as a normal balance, they have credit balance as a normal balance, right. So, the treatment would be entirely different. So, considering the paucity of time, I shall be beginning it the post the break, because we shall not be able to complete it. So, I shall be looking forward to your participation and viewership in the second half, where we are going to discuss many more adjustment entries. Especially we will begin with this revenue which is outstanding or in advance, both the situations. Thank you very much for being with us for half an hour.
With this note, thank you, ma'am. Thank you so very much for giving us this session. Friends, you are requested to be with us as we are back after a short break, and we promise to give you most of the information, most of the knowledge we have for you. So be with us. Thank you. Hello friends, welcome back to this session. Friends, as you know that today we are talking on adjustment entries in final accounts, and we have covered a number of entries in the previous session, and as promised, here we are again to talk on other entries. For the discussion on topic, we have with us in our studios Dr. Amarjeet Kaur. Dr. Amarjeet Kaur is a professor of accounting, and through her we always get in-depth knowledge on various topics of accounting. Now I would like to welcome our guest Dr. Amarjeet Kaur once again and would request her to continue further. Hello ma'am, welcome to the session.
Hello Geetika, thank you very much. Very good afternoon to you all and welcome back. So we shall be beginning with income now. So income, as I said, could be outstanding and could be received in advance. So as a part of adjustment entries, let's understand nature of income. So income is something which is credited in the statement of profit and loss account. It affects your gross margin, your net margins. So if we do not report a correct value of my revenue or income, basically it means my books of accounts are not going to show a correct, a fair picture. So it's very, very important that we show a correct and a very fair value of the income. So if we have not received something in which we actually have earned, we need to record it. And if we have received something advance which we have not actually earned, it should not be recorded in this current year. Okay, so with this background, with this premise, let's take some example to understand income outstanding. So it means you have earned but have not received. Same way we could have the income accrued as well. So as was applicable for expenses, accrued and outstanding concept is applicable on income as well, revenue as well. So revenue belongs to this year have become due. The due date was very much within this accounting year but have not been received. It means that is outstanding revenue. Same way, revenue has been received, has not been received, have been earned actually, but have not been received. But why have they not been received? Because they have not become due yet. They would become due in the next year. So that would be example or situation of accrued income. Alright, so accrued and outstanding expense and revenue, the both are same in when it comes to the basic nature. So with this fact in mind, let's now move forward and have an example to understand this concept further. So kindly have a look at the slide. It says extract of trial balance for outstanding income. So you have been given 6% loan. The amount in the debit side is 20,000 and you have been given 6% debentures of B Limited, 30,000 debit side. So both are investments, mind you, they are given. So assets are having normal balance. So it's very important that you know this is not our liability. So loan, 6% loan is not that something you have taken. 6% loan means you have given loan to somebody, because this is shown in the debit side. Same way, debentures of other company means this is your investment and you are showing it on the debit side because this is an asset. Now it says interest on loan, credit side. So revenue have always credit balance as a normal balance. So 1000 is given interest on loan. So how much interest should you be receiving? 6% of 20,000 means you should have been receiving 1200, whereas how much you are received in the credit side of the trial balance? 1000. It means 200 has not been received. They have been earned but have not been received, so they become outstanding. Same way we have interest on debentures given 900. How much you should have received? 6% of 30,000 means you should have received 1800, but you have received 900. So what is with the remaining 900? Let's see, either we have earned the whole money, either this remaining amount is outstanding or accrued, or what is there. So additional information says interest on loan is receivable on monthly basis and received up to October. It means I should have received, because 200 also become due by December. I have received up to October. So November and December months interest on loan, which is 200 rupees in total, 100 rupees for November and 100 rupees for December, have not been received. So it means they have been earned and have become outstanding as revenue. The second information says interest on debenture have become due on 31st March and 31st September, and company closes, third information says its accounts on 31st December. So it means the interest for the current year, which is closing on 31st December, we have earned interest only for 31st March to 31st September. Okay, so for the remaining 3 months we have actually earned, but that has not become due. So for 3 months, so out of 9, so 900 is for the 6 months which we have considered, but for the remaining 3 months, which would be 450 rupees, because 1800 for the whole year, 150 for each month. So for 3 months 450 rupees have not actually been earned yet, so they are accrued, whereas remaining 450 have been earned and they have become due, but they have not been received. Okay, so this is the difference. So how should we be recording? So let's have a look on the slide. The adjustment entries should be outstanding interest of 200 would be debited. This is a new account to be opened, and interest account would be credited. So interest has a normal balance of credit. So any income for that matter. So interest could be paid, interest could be received. So depending upon the situation. So in this case, the interest would have your credit normal balance. It's been given actually. So because it's an income, we are talking about revenue. So income having a normal balance of credit, and we are supposed to be increasing it. Why? Because we have earned and we have not received it. So to increase an income item, I should be crediting that respective item. So because of this rule, because of this fundamental fact, we should be crediting income account, and here the income is interest account. And what should be debiting? We should be debiting outstanding interest account. Okay, so this is how we deal with the item. So where would this item go in the balance sheet and profit and loss account? In the profit and loss account, interest account is already there in the credit side of profit and loss account or statement of profit and loss. We simply need to add another 200 rupees for this revenue which is earned but has not been received, this interest income. Okay, and in the balance sheet it would be shown as our asset. So as income not received, so outstanding income would be shown as an asset in the balance sheet, because you have actually earned and you have just not received it. So that is how we would be dealing in the balance sheet. Same thing would happen with the second item, which was interest. So, but the difference would be, instead of debiting outstanding interest which we did in the last time, here we would be writing accrued interest because it has not become due. So, accrued interest of 450 rupees, as we discussed the amount while discussing the question, would be debited, and again interest on debenture would be credited. So, this interest on debenture would be credited and would be taken to statement of profit and loss in the credit side. We will increase our interest part by 450, whereas in the balance sheet we would be showing it as a current asset as we did in the case of loan. So, both items would be dealt in the same manner, either that is an outstanding item or a accrued item. So, when it comes to accounting treatment, there is no difference. It is just a technical difference which we need to understand, of course, but when it comes to accounting treatment, there is no difference between the two, right. So, this was when we have earned income and have not received it. Either it has not become due or has otherwise have not received. What would happen when income has been received in advance? So, what should be the treatment? When income received in advance, let us discuss what would happen, on my variables in final accounts. Income which has been received in advance, it does not belong to this year. If I record it as it is, because the cash has actually been received, right. So, if I record it as it is, I am not sharing a fair picture, because my gross profits, my net profits would be higher by the amount which I recorded as income in advance, which I cannot do. I cannot mispresent my results. So, by recording the income which actually has been received in advance but does not belong to this year, because I have yet to deliver services or goods against them, then my books of accounts are not showing a right picture. I need to correct them. I need to pass adjustment entry so that I am showing a fair picture, a true picture of my books of accounts. So, income received in advance would be or should be reduced by the amount which has been received in advance, and it should be shown as a current liability. You received some cash, so your cash has actually gone up. So, cash is a asset, current asset, right. So, to reduce the effect or to counter, to show the result on the counterpart, we should be creating a liability, because my assets have gone up, my cash has actually gone up, right. So, I should be creating a liability in my books of accounts. So, this is how we deal with such situation. So, since the income has normal credit balance, so what should I be doing to reduce it? I think you know the answer. Yes, we should be debiting it. So, income being received in advance, income being having a normal balance of credit, to reduce the income account, I should be debiting it, right. That is how we are balancing off the effect. So, I should be debiting the respective income account and should be crediting an income in advance account. That is my, so anything received in advance would be treated as liability. So, that is how we deal with the situation. Let us have a look at the example here. So, it says extracts of trial balance, income in advance. So, it shows you particulars, debit amount and credit amount, 3 headings in the trial balance. Rent received for 12 months ending 31st March 2018, 1200. Interest on loan 2000, and both are credit side. It means they both are actually referring to my income. Additional information says interest on loan has been received in advance to the extent of 500. So, interest has been received extra, in advance up to 500 rupees, and firm is closing its books on 31st December. So, if books are closed on December and my rent is being received up to March next year, So what does it mean? It means for 3 months, which would be 300 rupees, because if I divide this 1200 rupees with 12 months, it means for every month I shall be receiving 100 rupees. This could be 100,000, this could be 100, anything 100, right? So it means this rent has been received in advance for 3 months, which is from January to March 31st, and I shall be making an adjustment for this. So what should I be doing? I should be passing an adjustment entry for both of them. Have a look at the slide. It is showing you rent debited to rent in advance account. As I said, rent has any income, not for rent could be an expense item, rent could be an revenue item, income item. Here rent, in this example, in this situation, rent was an income item, right? So income having normal balance of credit, we have debited it. In the adjustment, we are debiting it because we need to reduce it. So instead of recording the 1200 amount, I should be recording 900 in my profit and loss account. So that is why we have debited rent account. And in the second part of that entry in that transaction, we are creating a new account which was not there, and that is rent in advance. So rent in advance is a liability, current liability, and credited for 300. Same thing we have done for interest. So have a look at the this transaction. It says interest debited for 500 and interest in advance credited for 500. All right. So now this 500 is going to be reduced from profit and loss account, and what would happen in the balance sheet? So I hope you have understood how to pass an adjustment entry when it comes to receiving anything advance. But what would happen to your balance sheet and profit and loss account? The respective income account, which is rent and interest, would be reduced by the amount which has been received in excess, which was 300 and 500 respectively. So that is first statement of profit and loss. What would happen to balance sheet? It would be shown in the liability side, current liabilities in the balance sheet, because I have yet to give some service or deliver some goods against the advances which I received. Here it is rent, so I have yet to give the benefit to the person who has actually hired my house or building. Okay, and same way interest for the loan, the person has yet to use my capital which has been invested in the business. So this is how we deal with the anything received in advance. Now after this we shall be discussing about depreciation. So what adjustment entries are to be passed under depreciation situation and what could be the possibilities? So let's understand depreciation as a concept first, and two different situations, how could they be? As a concept, depreciation is an expense for any business. Depreciation as a concept, if we go further and try to understand it better, we actually spent on long-term assets, which is fixed assets or non-current assets, you may use any term. So on non-current assets, we spent in a particular year, in a particular on a particular day, with a hope to get benefit over a longer period for more than 1 year, right? That is my investment in non-current asset, which would be giving me benefit for more than 1 year. So the economic life would decide that how many years would be the benefit years for me. So economic or useful life of that business, of that asset, is going to be considered for the purpose of assessing depreciation. The point is, I have spent money in the current year, but the benefit is in future, in the long run. I cannot charge the whole amount spent on buying the asset in the current year itself as an expense, because the benefit would be received over the life of the asset, which is for more than 1 year. And as per the matching concept, if you remember the concepts which we discussed in the preceding lectures, we are supposed to match revenue of a current year with the expense of the same year, so that our profit or loss is reported correctly. So, if I do not consider this matching concept, then I may record the total expenditure on my non-current asset in one particular year, but which I cannot do. I have to abide by the guidelines laid down by accounting bodies in this regard, and I shall be charging only that much expense against purchase of that non-current asset, only that much which I have actually consumed in the current year. I have not consumed the whole benefit or whole life or whole investment in the non-current asset in this year. I would be consuming the benefits over its life in future. So, this is the premise, this is the background for depreciation. Alright. So, keeping this fact in mind, now question is, what do we do? So, basically when we charge the investment made in a non-current assets over its useful life, this is conceptually known as depreciation. So, spreading the cost of an asset over its useful life, to be precise. Now, why do we need to make adjustment entries, and what are the possibilities? There are two possibilities. One is that depreciation is given very much in the trial balance itself. It means it has already been recorded in the books of account. We simply need to show it in our profit and loss account or statement of profit and loss as an expense. If anything given in the trial balance, it would go only at one place, as a matter of fact. So, it will go only to the profit and loss account. But what would happen if depreciation is given outside the trial balance? And generally, you would be given a rate. Charge this much depreciation on building, charge this much depreciation on machinery, charge this much depreciation on plant and machinery, or you may say fixtures and furnitures. So, we should be given a rate and date of purchase to be correct or to be precise. So, if I have been given simply that charge this much percentage of depreciation on XYZ asset, we simply need to calculate the depreciation for the year and then pass a adjustment entry. Now, what should be the adjustment entries? Depreciation, as I begin with the statement, depreciation is an expense by nature, and expenses have by definition a normal balance of debit. So, expenses are having normal debit balance. I simply need to increase the debit balance, right? So, increase the debit balance by the name of the expense, and name of would be depreciation on building, depreciation on machinery, or whatever, right? So, by name we would be debiting depreciation on a particular asset. What should be credited? The particular asset on which the depreciation is being charged. Say for example, machinery. So, we would say depreciation on machinery debit and machinery credit, or you may say to machinery. Generally, I have seen people using the word to, even current days, which I don't do. So, we should be debiting depreciation and we should be crediting the respective asset, non-current asset of course. So, this is how we pass a adjustment entry. When no year, no date of purchase is given, no month, no date is given, it's simple that you charge depreciation for the whole year. But when you have been given a date and rate both, so when the date is given and the rate of depreciation is given, then it is recommended to charge the depreciation only for the period we have used the asset. So which means we should be calculating depreciation based on the date given. So because we have to charge the actual expense for the current year, which we have actually used the asset for. So this is the adjustment entry. When we have made adjustment entry because depreciation was given outside, so we have to take this item at two places, right? In the first case, when it is within the trial balance, it will go only to the profit and loss account. But when it is outside the trial balance, it will go to profit and loss account debit side by under the expenses, and in the balance sheet we will reduce the particular asset. If the machinery was, say for example 5 lakhs and we have charged 20,000 as a depreciation, so we should be reducing the asset from 5 lakhs to 480. So 5 lakhs minus 20,000 depreciation, your asset would be shown as 4,80,000 after this adjustment. This is one possibility. Another possibility is that we show the asset at its cost 5 lakh as it is, and we create another particular account, and that would be accumulated depreciation. That would be shown under the liabilities now. So accumulated depreciation of 20,000, whatever the amount previously we would have, we will add 20,000 for the current year. So that's how we do adjustment for depreciation. All right. After this, I would like to take bad debts. So what bad debts are? Bad debts is a situation, when we sell on credit. So we expect, of course, to get 100% credit sales, recover credit sales, but that may not be true for all the business for all the times. So when we are unable to collect or get, our credit sales or cash against our credit sales, that particular situation is known as bad debts. Now the bad debts is the outcome of credit sales. So if we have been given bad debts in the trial balance, so what do? It means they have already been considered, have been adjusted from the debtors, and we simply debit them in the profit and loss account. But these bad debts could be given outside the trial balance as additional bad debts. What do? So under that situation, bad debts is an expense because we try to increase our sales. Bad debts is basically the result of increasing our sales. It could be taken, for the purpose of understanding, it could be taken as sales expense as well. So we need to increase the expense as the expenses have normal balance of debit. So we shall be debiting bad debts and we shall be crediting debtors, a particular debtors by its name or sundry debtors in the group would be credited. That's how we deal with the bad debts. So in this situation, in the second situation, when they are outside the trial balance, we would take this amount of bad debts, say for example 5,000, to two places. One, to debit side of P&L account, and second, it will go to balance sheet and we will reduce the respective debtor or sundry debtors in total. So they would be reduced and we will show the net amount in the asset side. So that's how we will do adjustment for bad debts. I hope you were able to understand. We will have a very long discussion on bad debts in the future lecture, immediately next lecture, because we have provisions for bad debts, provisions for discount, additional bad debts. There could be many situations, and this is quite a complex topic which we are going to cover in the very next lecture. So I will urge you to be there with us in future so that you could actually grab the concept completely. Thank you very much for being with us for this half an hour. Thank you.
With this note, thank you, ma'am. Thank you so very much for giving us this session too. Dear friends, we believe that your feedbacks are very, very important to us. So if you wish to give your feedbacks, then do write to us at info.cec@nic.in. You can post your questions too, and we'll try to give answers to your questions when next time Dr. Amarjeet Kaur visits our studio. Till then, keep watching us and keep writing us. We are going to meet again soon. Thank you, ma'am. Thank you once again.
Thank you, Geetika. Thank you, viewers.